Hey everybody, welcome back. This is the Real Estate Guide to Success quick tip video series. I'm Vance Poindexter. I'm here with my man Ronnie Adams. How's it going?
Pretty good, pretty good. We're back one more time.
Want to try it again? Alright. Today's topic is going to be 5 ways for you to finance your next rental property. And we're going to start off by talking about using a bank.
Banks are good for what they're used for. A bank's going to hold 2, 3, maybe 4 properties. You're going to get a good interest rate. You're going to get low closing costs. But a bank is going to be a little harder on investment properties. You know, they want to do a loan for a property that you want to live in.
Okay.
You know, that's really what a bank wants to do. They will do the other properties, but they really want to do the one that you're living in. So it's going to be a little bit harder. But you can go to a bank, you know, they're going to run your credit, you know, and then if they deny you, you got to go to another bank. Okay. And they'll run your credit. So that's the only one thing you don't really want, because every time you get your credit run, then your credit can drop a little bit. Okay. You know, it's not very much, but you know, it can. Now, if you go to one bank, 2, 3, all 3 of them didn't do the loan for whatever reason, by the time you get to the 3rd and maybe 4th bank, they can see that they ran your credit. Now, they can't see whether they denied you, but they can see that it was run. So now they're like, okay, well, they must have denied it. Why? And he had the credit run in the last 3 weeks. So we know it's probably for the same thing. You could have went to buy a car, you know, so they don't know what it's for. You know, so you got to watch out with the bank. But the banks will give you lower interest rates and lower closing costs.
Okay. What about mortgage brokers? Now, how do they play in the full
financing? Now, a mortgage broker, they're going to do a loan most likely that a bank won't do.
Okay.
A bank will say, they may look at your credit and say, well, you don't qualify with our standards. You know, their standards on an investment property could be pretty high. So a mortgage broker, his may be lower. Okay. He's going to shop your loan, or she's going to shop your loan to 3, 4, 5 different lenders. They're going to run your credit one time.
Just once. Okay.
Just once. They're going to show that credit to the other lenders. Those lenders would say, okay, we could do the deal, we couldn't do the deal, whatever it may be. When they say that they can, then that lender's going to run your credit to verify that that is your credit, that's what it is, and they would do the loan. So your credit was only run twice for one house at that point. Now, the mortgage broker, their loans are going to, their interest rate's going to be higher, and their closing costs are going to be higher. You pay for that service that the bank wouldn't do. You know, it costs you a little bit. So
now, talking about increased interest rates, we also have hard money lenders down here as an option.
Yeah. Now, the hard money lender, they're going to do what the bank or the mortgage broker won't do. Okay. You know, so you could have a house that, you know, need a lot of work. So now the bank's going to say, well, that house, you can't get a CO, a certificate of occupancy. So we're not going to do the loan. Okay. You know, the mortgage broker may not find a lender who's going to want to do a house that needs a lot of work. Okay. You know, they'll do some, but they don't want maybe a whole bunch. Okay. You know, so but when you go to that private lender, then or that hard money, then they're going to say, we'll do it, but your closing costs are going to be high, your interest rate is going to be high. But what you end up doing is you take the money, you buy the property, you fix it up, you're going to already figure, hey, I'm going to pay 15% interest rate, which is hard, you know, so that's why they call it hard money, you know, but I'm only going to pay it for 4 or 5 months, you know, and then I'm going to refi with the bank or the mortgage broker, because now the house is up to the position where one of those other lenders will go ahead and do it. It will be willing to do it. So you would use the hard money for what they're there for. Okay. Now, the bank, you're probably going to hold that loan or hold that house for the duration or for a longer period of time. It's going to be a nice rental. Yeah. Mortgage broker, you can go either way. But when you're dealing with the hard money, you're flipping or you're refining that house, you know, because some hard lenders will only allow you a year, you know, with the loan. So they want you to refi them out anyway. Okay. They're looking for a quick hit, and that's about it.
And in that same vein, I think you start talking about private money investors. Mm-hmm. They're also another option you can use that where the interest rate's higher, but it's still available.
It's still available. It's definitely still available. If you're going with a private lender, then the banks, the mortgage broker, and even the hard money lenders, they still have to deal with some of the rules and regulations that the state puts down on mortgage companies.
Okay.
the private money, they don't have to. It's their money.
They
They
can
can
do
do
whatever
whatever
they
they
want.
want. You know,
Okay.
so now you're going to pay for that service. Now you're going to pay as we keep going. You know, as we go down the list, then you go higher on the interest rate and you go higher on the closing costs. But you're going to be able to get a house that none of the other institutions would do,
Right.
and you're going to get a quick hit, being buy the property, fix it up, and I'm going to refi out.
Okay.
You know, so you don't want to get stuck
Right.
where you can't refi out with one of those people. You know, you already have to plan
All right.
that, okay, when I buy this thing, I'm already going to go to the bank or the mortgage broker and say, I'm going to buy this house. It's going to be fixed up. Would you do the loan once the house is fixed up?
Right.
They're most likely going to say, okay, well, if it's fixed up, yes, we probably would be able to do it. Because I got to get out, so I have to plan.
Okay.
That's what you want to do.
Okay. And the last one we have here, I know is the way you started, is near and dear to your heart, using the credit card as cash to get the property.
Using the credit card. Unless we have, you know, hundreds of thousands of dollars just laying around,
I
then which we do not, then we have to use other people's money.
Right.
You know, other people's money happen to be credit card.
Okay.
Now, when I started, I, you know, bought a house, and one of the articles or the podcasts that we did talked about the house was, I think I put maybe 35,000 into buying and fixing the house up.
Right.
But I had a credit card, I had a couple credit cards to be able to get money off of them, and I used that money to buy, fix up the house, and then I refied with the bank or the broker. I
Okay.
actually used the broker at that time. So a lot of, you know, people will say, well, I got, you know, a credit card that has, you know, 10,000, but they'll only give me 2,500 cash advance. So, you know, we'll do another podcast or another video series to tell you how to get the money off.
Okay.
You know, there is a way to do it. If you can get one credit card to give you all the money, then you can actually get all three of them off there.
So that's another option. Everybody, please go to realestateguidetosuccess.com to find out other ways of financing that next property. There's podcasts, there are videos, there are posts there. Please go there and check out what we have going on there. All right. Appreciate it, man.
Well, we did one more.
More good.
All right.
Take care.
Thanks.